Back in March, Zillow, the United States' most visited real estate website, came out with a bold decree. U.S. home prices would rise another 17.8% over the coming year. But contrary to the expectations just weeks later to that proclamation, the boom was replaced by a housing slowdown, and home sales have been declining since then. In fact, sales fell for the sixth straight month in July as the rising affordability concerns sideline potential home buyers. Since then, Zillow has revised its forecast and expected that between July 2022 and July 2023, U.S. home values would rise to 2.4%, and that's down from 7.8% forecast the company published just a month earlier. Fortune magazine describes this situation as such. If you own a $500,000 home, the carnage in the market has wiped out $27,000 in anticipated home price appreciation. A revision like that only happens if the forecast inputs have soured. What does this all mean for the real estate market? Why are they experiencing all of this? What does the future hold for both real estate developers and home buyers? Are we on the verge of a housing crash? Hello my YouTube friends, I hope you're doing well. I am Keith Raven, and in this video we are going to get a closer look at the ongoing situation of the U.S. housing market. The sharp fall in housing prices adds to the existing threats to the economy, and it hasn't spared the U.S. market either. So if you want to know more about the recent real estate market, make sure to watch this video until the end. Also, please take a quick moment to subscribe to the channel and hit the bell icon so that YouTube algorithms know for sure that you like watching our videos. Now that the boring stuff is out of the way, let's get into the video. First things first, where do we stand in the real estate market? According to Fortune magazine, across the board, the housing market weakened in July. The month saw the largest ever, dating back to 2016, uptick in total inventory on Realtor.com. On a year-over-year basis, new home sales and existing home sales are now down 17.4% and 20.2% respectively. At the same time, single-family housing starts have fallen 18.5% and mortgage purchase applications are down a whopping 18.4%. Now, according to Zillow, 30 of the nation's 50 largest housing markets saw month-over-month home price declines in July. That includes a 4.5% home price dip in San Jose. Not too far behind are Phoenix, Arizona, down 2.8%, San Francisco, California, down 2.8%, Austin, down 2.7%, and Sacramento, California, down 2.5%. These drops have led to tension among experts who are increasingly worried that the housing market collapse would spark a recession as the Federal Reserve raises interest rates. The tension is surely valid because of the crazy situation we're in. In fact, the interest rates have hit the largest 30-year mortgage rate. We are also fighting inflation, and it would not be wrong to say that the U.S. is barely managing to keep ourselves afloat. Moreover, we are chained by a war crisis. Gas prices are skyrocketing to their all-time highs. The stock market is bottoming, and the cryptocurrency market, as you all might know, is crashing and is now nothing compared to where it was last year. Fighting the real estate turmoil amidst these existing crises is even more difficult, and this forces us to believe that the housing market is a very strong candidate for crashing this season. But on multiple occasions, Zillow has affirmed its view that we're in neither a housing bubble nor a housing crash. Instead, it views this as a housing market trying to find equilibrium amid a period of spiked mortgage rates. Other analysts also may refer to it as a phase of cooling off, but crash, they believe and are hopeful that that won't happen. But before reaching a conclusion, we must understand how we got here in the first place. What brought us on the verge of a housing market crash? If you dig into the data for the interest rates, you will notice that the pre-pandemic rates for about the past 30 years were sitting close to around 3.5%. And as the pandemic began, we saw widespread economic turmoil because of the uncertainty about the future. People began accumulating supplies, and this created stagnant money pools. And when money is not changing hands, the whole economy suffers and people lose their jobs. This, in fact, a win-win for many people as the stock market and asset prices like real estate go up. But as you know, the happiest moments are the shortest. An important thing happening at this time was that the Federal Reserve kept on buying U.S. Treasuries and mortgage-backed securities. In fact, between 2020 and 2022, they had bought around $1.3 trillion in mortgage-backed securities. And then came the major disaster. As a direct approach to solving this issue, the Federal Reserve and the government started pumping massive stimulus package into the United States economy and also brought down the federal funds rate. Funds rate is the cost at which one bank buys money from the other bank. And due to this, depreciation made borrowing money a lot cheaper, with the funds rate as low as 0 to 0.25%. Now, people could borrow money without having to pay much interest at all. Therefore, they kept borrowing more and more money, and this brought on a huge purchases and spending problem. This huge level of buying prompted their market, and their prices shot to the moon, leading to record low yields, which also spurred the record low mortgage rates. The cost to borrow money, interest rates, got cheaper and cheaper to get these mortgages, and the extremely low interest rates directly affected the United States housing market. A general consensus of this could be a lower demand for housing and a decrease in the cost of new home purchases. But this year, 2022, turned out to be a little different, as housing affordability continues to become a problem for new home buyers in the United States. Private surveys have highlighted that Americans feel the biggest problem where they live is affordable housing, even more problematic than the availability of jobs, drug addiction, crime, and racism. The Fed wanted to control inflation, which is the most pressing issue these days. They hoped that by increasing the interest rate, they would discourage the buying behavior in the country by lowering the demand, with the ultimate goal of lowering the United States inflation problem. The increase in interest rates would also mean an increase in home buyers' mortgages. That we saw as well, as the 30-year average mortgage rate in late June reached around 5.81%. But how do interest rates actually affect the housing business? According to Investopedia, interest rates determine how much we will have to pay to borrow money to buy a property, and they influence the value of the real estate. Low interest rates tend to increase demand for property, driving up prices, while high interest rates generally do the opposite. As the Fed exited the mortgage-backed securities and as inflation around the United States built up to around 8%, and due to the fears of economic recession, the Federal Reserve acted aggressively and they decided to raise the federal funds rate. The government raised the rate by 0.75% after just one meeting. In another survey, young adults believe that they have a harder time buying a home than their parents' generation did. The unavailability of homes on the market is due to the rising demand and limited supply, resulting in higher prices. If you look at the record for the past 3 years, home listings are down over 54%, while on the other hand, the prices of sold homes have increased to around 45%. A recent study by the Fed found that demand played a larger role in home price appreciation, not supply. And this explains why the Fed wants to raise their Fed rate, as it will indirectly result in a higher mortgage rate, which should bring down the demand of buying a new home. That brings us to the very start, the declining housing sales, to which Zillow refers to as the phase of stabilization. Due to this fact that many analysts think that the market isn't actually drowning, but the decrease in demand is actually a cooling off phase. And the fact it is happening at a pace consistent with the Fed's estimates says a lot that the situation is still under control. But as inflation is still rampant, the Federal Reserve plans to continue raising the interest rates for home mortgages, which means that we could be seeing a 7% mortgage rate by the end of 2022. So that was it from my viewpoint and from the information that I have read. I hope you liked this video. If you did, please subscribe to the channel and ring the bell to keep getting updates from this channel. We'll see you on the next video.